Hello. So I've already done videos on writing a put and covered calls / deep in the money covered calls. Now I'm going to introduce you to the vertical spread and the diagonal spread. I'll use a call example, but the same strategies can be used with puts. So as usual, the first thing required is to pick an appropriate stock. So I'm going to go to my stock screener here, and I'm looking at US financials in this case. And I want something that's near lows because I want something with limited downside risk. So I'm looking for something near its 52-week lows, trading at a reasonable PE. So scrolling down, I noticed American Express, basically at the 52-week lows, reasonable PE of 13.31, a beta of 1.1, so trades with the market, and a small dividend. Now I'd rather it didn't have a dividend at all, just because that adds in the element of people exercising early to call away the stock before the dividend, before the ex-dividend date. But in this case, I just have to be aware that there is a dividend and be aware of the ex-dividend dates in case it's going to be called away. I need to be prepared for that. So now that I have the stock I'm going to use, I need to go to an options chain. So I have a simple one pulled up here for January 20th, 2017. It's the furthest out you can go. And I'm going to be looking at buying some in the money calls here. So deep in the money, all the way up to a little closer to the current price. And then I'm going to sell one that's out of the money. So current stock price, again, 75.93. So I'm going to buy something in these lower levels and sell in these higher levels out of the money. So I'm hoping that American Express will at least hold steady around this $76 level and preferably go up slightly. Now I'm not going to show you the Greeks on this, but I'm sure you all know market probabilities, and the odds are that American Express will close at or above the current levels 18 months down the road when this option expires. So that's why I generally prefer buying the in the money and selling the out of the money, because that provides the most possible return if the stock stays flat or increases. You could do the inverse, however, then you would be benefiting from the stock going down, and it's much more likely long term that the stock will increase. And I'm not going to show you the Greeks on this, but we all know markets in general move with a slow incline over time. So 18 months down the road, all other things held constant, we would expect a stock to be slightly higher than it is today. Looking at the Greeks for this one, it was about a 65% probability that the stock would be above these levels in 18 months. So I'm fairly comfortable with that. That's why I generally like to play the long. So now I'm going to look at a few different strike prices and play around with some numbers to see what kind of returns I can get. So if I go closer to the money, I can get higher returns, but I'd also have a higher break-even point. If I go deeper in the money, I have to put a lot more capital down initially, but it lowers my break-even point, however also lowers my returns. So next, an options calculator is required. This is the one that I have created. It's available to all of our subscribers. And this allows me to enter in different numbers and calculate what my costs would be, my max loss, my max gain, percentages. And I've put in a few different strike prices. The buy strikes of 70, which is the closest one to being in the money. And then I put a couple lower ones, 42, 50, and 50. I kept all the same expiries for simplification. January 20th, 2017, which is 18 months away. Then also for simplification, I put all the sell strikes at 77.50. So these would be my costs of each option on the buy side. So as you can see, the one that's closest to being in the money, so the $70, I would be paying about $11.35. So the cost would be $4,550. Now as you get down to the lower strike prices, this cost increases significantly. And the 42.50 strike price would have a premium of $33.60. So that would cost $13,450. So now I'm going to look at my three scenarios. Again, the strike price closest to the current stock price is going to be the least expensive, and thus it's going to have the lowest maximum loss. So in this case, the most I could lose after selling a 77.50 strike at 7.30 is $1,640. So that's only 36% of my initial investment, and I stand to gain almost 30% should American Express trade above 77.50 by January 2017. The lower two buy strike prices would provide returns of about 26%. Again, if it reaches a 77.50 strike on expiry. However, these would have a much greater maximum loss risk. So upon analysis, I think the $70 option would be best, with a max return of almost 30% and a max loss of 36%. Now these all take into account all commissions, which again is very important, and that's why you should have an options calculator to make sure to include all of that in your calculations. So in this case, I would definitely go with the $7 strike. The only disadvantage to that, your break even is slightly higher at 74.12. But again, 18 months out, I'd be fairly confident that American Express should reach the 77.50 strike price. Now, macro events aside, you never can be sure, but markets generally do move upwards, and the probabilities are that American Express will close above 77.50 by January 2017. Now, I actually do buy deep in the money calls often. However, I do not do a vertical call spread. Instead, I do what's called a diagonal call spread. Now, I do this because, again, it gives me a much lower break even, and I want to make sure I'm profiting. But instead of selling the January 2017 strike prices of 77.50, I'm going to sell a more recent one. So I'm going to sell them a month out, or you can even do weeklies. So we're going to look at now an example of a diagonal call. I actually started doing diagonal calls before I knew much about this strategy. I didn't even know what it was called. I just realized that near-term calls have a quickly deteriorating time value, and I wanted to capitalize on that and keep collecting monthly premiums as opposed to one premium in the future. Over the long term, this generally benefits you much more having small monthly premiums as opposed to one far out premium. Now for the diagonal call, I'm going to keep the same January 2017 expiry and look at the deep in the money buy strikes of $42.50 and $50. However, instead of selling a January 2017 strike, I'm going to sell a strike again of $77.50, but instead of going all the way out to January 2017, I'm going to look at next month, so August 7th, 2015. And you can pick anything out of the money here. I looked at 77. For consistency, I'll keep 77.50 because that's the one we used for our last example. So again, for all my estimates, I kind of split it right down the middle for what I expect to get. But you have to play around with those with the bid ask to try and get the most you can. Now, in this case, I'm collecting much less revenue, obviously, because I'm collecting it for only 1 month. However, this revenue is a pretty good chunk of my initial cost. So I'm getting about 3.55 or 4.33% of my initial cost outlay back that first month. Now, if in that first month, American Express rises, goes above the 77.50 strike price, I'm already going to be in a profitable position. So that's key. I don't want to set this up where I'm selling at a strike price too low and the stock skyrockets and I'm actually in a negative position right off the bat the first month. Now I'm getting much less premium, obviously, because I'm only going out 1 month as opposed to 18. However, this premium is still a good percentage of my initial cost. So 3.55% or 4.33% of my initial buying cost. And I set it up, again, making sure that I've calculated all of this, so that if the stock does skyrocket that first month, I'm still going to make a profit. So if the stock goes well above 77.50, let's say to 80 or 85 for whatever reason, I'm still going to make a profit of 7.54% or 3.93% in 1 month. So that's a fantastic return. It's important to calculate this though, because it is possible I could choose a strike price maybe at 76 at lower prices, lower strikes, that perhaps wouldn't get me any profit. So I want to make sure there's some profit in it, even if the stock goes very high very quickly and I only hold the options for 1 month. Now the advantage to this strategy is I'm collecting a rather large premium when you compare it to what I would get for just writing one premium out 18 months. $1.22 each month would get that $7.30 in much less than 18 months. So if American Express just trades flat to slightly up, I'm going to collect a lot more premium collecting it monthly than I would in one lump sum 18 months out. Now my initial break evens are 75 and 76.40. So one slightly below the market price, one slightly above. This is generally what you want. around the market price, you're already at break even first month in. Then each month you're going to collect more revenue. So the next month, ideally you're going to sell and get another premium around this. So just for purposes of an explanation of the strategy, if I did this for 18 months, 18 times 478.01, that's $8,604.18. So this is completely hypothetical. The stock is going to move up and down. You're not going to get the exact same premium every month. But just as an example, this is how much premium you could collect. So your returns are 73.97% or 78.01% of your initial cost. So that is much better than the vertical call spread. Again, this is a purely hypothetical scenario, but I will use one that I actually did a couple years ago, ironically on American Express. And I've done this strategy many times. It's proved to be profitable about 80% of the time. And one of the best situations I had was with American Express. I had a 14-month contract with a buy strike of 25, so I put down a little over $5,000. And my initial revenue was $246.51. But then I kept selling month after month after month, collecting anywhere from $50 to a few $100s. At times, the stock went above the 57.50 strike price. So I had to buy back my call and then sell again the next month at 57.50 again. I kept doing that, kept around the same 57.50 strike price, and in the end made a profit of $1,715, which was a return of 34%. Now this amounted to 2.47% monthly, or just under 30% annually. So that's a pretty good return for this strategy. And again, that's after all commissions. Now, as with any strategy, you should be prepared for all possible scenarios. So what happens if the stock does skyrocket in the first month? As I said, that's why you set it up, so you are making a profit even in the first month. And then you can choose to either close out the position and take this gain, or you can buy it back and then continue writing the next month. However, I don't necessarily like that strategy because your premiums get to be a lot less the further in the money you are. And if you write out of the money and then the stock pulls back, you could be losing some of those gains that you just accumulated. Now, what about the worst case scenario? So worst case scenario is the stock plummets. Now the stock is currently just under $76. Let's say first month the stock just drops down to about $71. Drops about $5. So now you've got to sell a premium the next month that's $5 out of the money. So in this case, we'll go $5 out of the money just so you get an idea of what you could collect premium wise. $5 out of the money would be right here at 81 in this case, but we would obviously be at lower levels if the stock drops. But just to get an idea, a $5 out of the money premium would only get you about 36 cents per month. Now, unfortunately, this is not a good scenario for you. However, 36 cents per month for 18 months plus your initial $1.22 premium, that still amounts to approximately the $7.30 you were getting for the vertical call spread. So worst case scenario, Now this is a pretty unlikely worst case scenario. American Express drops $5 the first month, and I'm only able to collect tiny premiums, a fraction of what I was collecting when I was close to the market price. Even with this worst case scenario, if I can still collect only 35, 36 cents a month, I'm still going to be able to make as much as I would using the vertical call strategy. So that's for Rachel Fox to explain why diagonal over vertical. That's a perfect example right there. Now, one warning, if the stock does drop significantly the first month, so again, we'll say it drops down $5 or so, some people are tempted to still write a call near the market price. However, remember you just lost $5. So if you write the next strike price up, you may actually end up in a negative position should the stock all of a sudden bounce back up through your strike. So if American Express dropped down, I'm $5 underwater, so I say, okay, well, I'm going to sell an option next month for just under $2. Well, if the stock suddenly skyrockets, bounces back up, I lost $5 in my position and sold a call for only 2, so I'm still underwater. So you had your initial month of $1.20, you add in 2 more, $3.20, you're still underwater if the stock drops $5. So just be careful with this. Again, always use an options calculator. And I always try to make sure that should the stock go through my strike price, I'm going to be in a positive position. Now, the diagonal call strategy is probably my favorite option strategy. It works great to collect small amounts of premiums each month. However, if you have high commissions, don't invest a lot in your options trades and are not very active, this is not the strategy for you. This is for someone who doesn't mind putting a few $1,000s into each option trade such as this. Someone who has low commissions. So I would say $5 to $7 is the max you would want to be paying per trade. And then also someone who's active, who doesn't mind writing these options every week or every month. If that's you, then this is a great strategy, and I enjoy implementing this strategy. So that's it for today. I hope you enjoyed it and you learned something about vertical and diagonal spreads. Please follow at Day Trade Canada, visit the website, and share. And you can ask me questions anytime, or if there are any topics you would like me to discuss, please feel free to ask. Have a great day in the markets.